Get dressed. I'll show you my charts.
All right, charts to watch, folks. We got 420 for you. Happy 420 and happy Easter. We're going to look at weekly charts in this episode right here, but before we do that, let's look at the futures, how they look like, and tie in the conversation with the title that you clicked on. We begin with the E-mini futures daily chart. What do we see here? We haven't had a decisive close below 5,300, otherwise we would have had a definitive conclusion that we're heading down to revisit 5,000. And there's a really juicy trade here between 5,300 and 5,000. I hope they're not going to exhaust all of it overnight. We open gapping down big. I hope that we're gonna trade around 5,300 all the way to the morning. Then we look at certain indicators, and if they align and we continue to trade below 5,300, then we're gonna take a trade against the E-mini futures all the way to 5,000. And it could be in the form of, for example, a spread for May or June when you buy the 5,000 and you sell the 4,800 with a booster of a weekly put at the 5,000 level, because I think if we have a flush here, it'll be a really, really juicy trade. We can be back at 5,000 in no time. Now, usually when a chart finds solid support, there is no need, when you get a solid support right here, big rebound, there is no need to go down and retest that support again. 9 times out of 10, when that happens, the chart is going down because it has no confidence that this support is solid. And once it retests that support, it breaks it and initiates a flush down kind of leg to the downside. And why do we see the E-mini futures trading in the red overnight? Because somebody's still dumping the US dollar and US bonds. I mean, this is what the chart looks like. We thought the dollar would be already oversold. It consolidated in a bear flag, and now it's heading down again, meaning somebody's dumping US assets. Somebody's dumping the dollar, somebody's dumping US bonds, and that's causing the systemic fear to increase. And with it, of course, we see credit spreads now beginning to show their ugly teeth, and then you have the E-mini futures trading down. So if we continue to see the dollar and bond yields heading higher, in the case of the dollar heading down, but bonds heading down, so bond yields heading higher, that's going to be a lethal combination for the market, and indeed will open the path for that 5,000 retest in the E-mini futures. And I'm looking right now at the 10-year yield. It looks like momentum is about to accelerate to the upside, retest to 4,300, and then heading back up to the dreaded number of 4.5. That would imply that we have somebody dumping again U.S. assets, and that could be a sign of lack of confidence by foreign investors or retaliation against the trade war. And of course, when you have this dynamic of lack of confidence in the dollar and bonds, the only resource becomes gold. So you look at gold futures, that continues to go higher, and now it's becoming alarming because gold is overcrowded. You see here that it is overbought, and usually we have consolidations or pullbacks when it's overbought like this. As we've seen here, a pullback. In the previous example, at least consolidation, but here it just keeps going and going because of inflows. And when you don't have the dollar or bonds as a resource of safety, then gold becomes the last resource, and folks are piling in. I'm not going to make a judgment on the entry at this point because I've been waiting, and it never really happened, never really got a decent pullback. So I didn't add to my position. But of course, I'll leave that judgment up to you. If you think it's a good time to enter and you think that gold is going to head higher because there is no other alternative, then you got to make that decision. I entered in Q3 of 24. I'm happy with the position right now, but I would love to add to it. Now, folks, when we talk about are we seeing the stock market predicting a war? Why do I say that? Because you see the dollar keeps going down. You see U.S. bonds continuing to go down. So there's lack of confidence by international investors about the future of the United States, about the dominant position that the United States has presumed since World War II, economically at least. And when you have such lack of faith in the dollar and bond and U.S. bonds, that becomes sort of a massive national security issue where we have folks maybe looking for other currencies. And there is a vacuum that China could fill. And this is why I tweeted just a few minutes ago that I think if the dollar and bond yields continue to go, or dollar or U.S. bonds continue to go down, leading bond yields to head higher, and let's say that the Pessac and the Federal Reserve collaborate in buying bonds and fluffing up the dollar, and that doesn't work out because we continue to see more and more dumping, then the last resource would be for the United States to start a war, to show the world that we are dominant, and whether you like it or not, you have to buy our dollar and bonds because maybe we have shitty finances, but we still got the biggest military. and we can do a lot of damage with it. So you better stick to the program here. I think that could happen, and maybe the charts are speaking right now. And if they are, then why do we see the dollar going down? Why do we see bonds going down? We see gold heading higher. Even crude oil in the last few sessions been moving higher. And then we see the defense contractors. When we look at the bullish weekly charts, a name that comes to mind is Lockheed Martin, which has been a big loser since the elections because the assumption was that we're going to have cuts in the defense budget. On the contrary, the Trump administration now spending over $1 trillion in the defense budget. So a lot of the assumptions that happened here on the way down have to be reversed because the administration is not spending less. And as this trade war worsens, I think we'll spend more just to restore confidence in the dollar and U.S. bonds by flexing our muscles, if you may. If we look at the chart right here for Lockheed Martin, look at the weekly MACD. Negative momentum been going on since the elections, and now it's changing back to positive. And I think the chart here found some support, and you see the volume increasing as if there is accumulation happening here. And once we have a confirmation of trading above the 50 weeks moving average, that's going to be about a little over 500. That's going to be the ultimate confirmation that Lockheed flipped from bearish to bullish. We already see the leading indicators in the MACD. You see it in the RSI, you see it in the Vortex indicator. So I think that so long as Lockheed trades above 460, it is a buy. It is one of the few charts in the market right now that I can say they're a buy. Another defense contractor is GD, General Dynamics. Now, it's been the week, so maybe it's not the best name to follow in defense. Maybe Lockheed and Northrop would be better, but some folks still prefer to get the opportunity in terms of valuations because General Dynamics is cheaper. And maybe it has sort of an inverse in its shoulder pattern, awaiting a confirmation of closing above the 50 weeks moving average, but you see the confirmations in the MACD already of bullish momentum. You see it in the RSI and the Vortex, so GD fits the bill. Perhaps the best looking chart in defense contractors, NOC Northrop. You see the inverse in his shoulder already played out, and we have a breakout here. We're probably going to retest the highs. The highs here were about 555.5. We're going to retest that, maybe have a pullback, and that's going to be your opportunity to enter Northrop NOC shares because they're one of the few ones that look bullish. You see the bullish Vortex, you see the bullish RSI, and the MACD in the weekly charts. But folks, if we're betting that NOC will go higher, if we're betting that Lockheed will go higher and the dollar going down and we see bond yields going down and gold going higher, again, is the market really predicting a war here? I think this is the case, and the market usually right more than wrong in its predictions. And right now, I think the market, if it is speaking, it is saying, watch out, there is a risk of war. Now, what about Raytheon? I would actually sell my Raytheon shares. This is what I'm going to do this week. I'm going to exit Raytheon. I made good profits on it. And the reason is Raytheon still has exposure to China. It was my opinion up to this point that Raytheon is the best name in defense. But now that we're changing the dynamics, we don't have cuts in defense budget, we have increases, and we have so many geopolitical threats right now with the trade war. I think that the traditional NOC Lockheed Martin will give you really good value right now. Raytheon, because of that exposure to China, I think money's going to rotate. And I'm going to start that rotation by exiting my Raytheon and buying perhaps NOC or adding to my Lockheed. Another defense contractor that I'm dumping from the portfolio is HWM. So it's been fantastic performer. It's still above the 50 weeks moving average, but it has negative divergences in the chart.